Arguing about whether the stock market is in a period of euphoria is not the point of this video. You can read those kind of debates elsewhere. The goal here is to provide you with some tools to respond to persistent highs in the stock market. At the recording of this video, the stock market has been at or near all-time highs. Regardless of where the stock market is while you watch this is irrelevant. These are just a few things to consider when the stock market is at highs. Number one, recognize that it doesn't last forever. Bull markets end, bubbles pop. Stock market history reveals that markets go up, down, and sideways, sometimes for long periods of time. The key is not to make knee-jerk decisions, but to engage in thoughtful, prudent investment planning. We don't want to react based on euphoria or based on crashes. The enduring goal is not timing sells and timing buys, but consistently investing in up and down markets alike. Number two, don't just wait for the crash to invest. Some have not reaped the harvest of gains because they have been sitting on the sidelines in cash awaiting the next big crash. The problem with this line of thinking is that you might be waiting a long time. Furthermore, oftentimes cash doesn't beat inflation. Let's say you've been waiting to invest ever since the financial crisis going back many years ago, or ever since the COVID crash. When the crash finally happens, are you really going to invest then? For example, in that COVID crash, did you get back in or did you wait because you thought it was going to keep dropping? If you were afraid to act when markets are up, why wouldn't you continue to wait, convinced of further market slide and even better prices ahead when all the headlines are apocalyptic and markets are falling? I'm not saying you should be in the market. That all depends on investment objectives, time horizon, and risk tolerance. But you should take time to think through why you are not. Number three, clean up your own balance sheet by paying off debt and building an emergency fund. While some think cash is king, others want to borrow money to invest. In the Great Recession, the banking system was in deep trouble. Words like leverage, debt, and lending inside financial institutions' balance sheets became household conversations, and a reckoning arrived. Companies failed and balance sheets needed to be cleaned up. So, take a lesson from that. Do not wait for the personal or national economic crises to clean up your own balance sheet by paying off debt and having an emergency fund. There are all kinds of recommendations about how much an emergency fund should be and how long it should last. 3 months of current income, 6 months of expenses, a year or two. Don't get all hung up on that. Just get hung up on having one and do what you can to add to it. Start somewhere. Having an emergency fund in place saves you from having to sell your investments at the wrong time or to go into debt. Number four, gains can be given up quickly. Individual stocks can begin to take up too much of a percentage of your portfolio. Think about diversifying to other parts of the market that have been beaten up or might rebound. It's easy to stick with what's been working, never selling because of fear of taxes or falling in love with one stock or one sector of the market. But hot stocks have been known to fizzle fast and popular sectors can move out of favor. Number five, spend some today. This point is especially for savers. There comes a time when savers need to learn to spend, go on a vacation, buy that car, fix up the house. Your money should be saved and invested, but that's not all it's for. It's also meant to be enjoyed by you and not just saved up for someone else. Number six, give some away. If you've done well, consider donating to those who haven't done so well. Maybe it's a family member or a friend. It could be a tax-deductible charity or church that serves local, national, or international needs. Here's another option. Fund hospitals or research that is aiming for scientific breakthrough. Find value in what you give, not only in what you gain. Number seven, hire a financial advisor. Are you taking on too much risk? Are you saving enough for retirement? Do your investments match your plan? Here's the thing. Easy money found in high markets end. Markets don't always go up. Investing for the long haul is hard. Maybe check out our website at www.jwealth.co and set up a complimentary consultation with us. Whether it's us or another financial advisory firm, you can do all kinds of research. You can go to FINRA and do a broker check to check in on the past history of your financial advisor. Just make sure that you're with somebody you trust. And remember, it's not just about you. Somebody your spouse trusts, somebody that the future generations of your family might trust. And as far as markets go, whether they're high, whether they're low, this investing thing is hard. It's so easy to get caught up in our behavior, caught up in news, caught up in this, that, or the other thing. So you might want to enlist some help. Hey, if you like our content and you've enjoyed our channel, watch a bunch of the other videos. Send it to a friend, like, subscribe, share our content. We'd appreciate it.